US 10Y. The 10-year Treasury yield reflects the return investor demand for lending to the US government over a decade. That is why you have it as a US 10Y. The return you expect in your investment for lending money to the US government under 10 years. So we have US 30, US 2Y, we have a US 10Y. So this is 10-year expectation of interest, which on the money you lend to US government. You see, this is very important because it affects inflation and also sets economic outlook. It's a key benchmark for mortgage rate and other long-term borrowing costs. So it's important that every trader watch the US 10Y performance. It's a strong indicator. It's a strong market indicator. So we have seen what happened on Friday after we've got average hourly earnings staying the same and non-farm employment change. The non-farm employment change disappointed us. It disappointed us, and we have seen what market did. Market reacted immediately, and we have seen that the yield dropped drastically. And it's not a good thing because the data came in way below expectation, 73, as against the forecast 106. But however, still stands greater than the previous data, while unemployment remains the same, 4.2, and current data exceeding previous. We had the final manufacturing PMI, that is Institute of Supply Management, and Purchase Managers Index. That is what it means. We have seen that the data came in 49.8, and that was a slight 1 point ahead of forecast, while the ISM manufacturing and PMI came in below expectation, 48, which we also looking at it because ISM manufacturing PMI is also a strong indicator of economic health and also gives a clue on general economic outlook. So when we're looking at a US economic outlook, we put a whole lot of data in combination. It's not just only one data. We look at the CPI, we look at the GDP, we look at the non-farm, look at the employment change, you look at the unemployment change, you look at the final PSI, you look at the PCE. All these are all index data that we put together, and even the Federal Reserve use those parameters in making monetary policy changes, and it's something we're going to look at. So let's look at the structure from a daily perspective. We have seen here in March 2024, we create a support structure, breakout structure, supply roof, sell. When we broke supply roof, return here as a buy, and we have bought to return here to respect it, giving us an ascending trend line. When we broke the structure, we aligned with another structure, which technically gave us a buy position after we've seen the 10-year Treasury yield drop to 3.88 in the month of April. Then from there we recovered and we moved up, and technically we are holding this level at 3.987 for another buy opportunity. But at the moment, we see that price has created a strong ascending trend line on daily candle close. The daily candle close is given us here as SR1, SR2, and price return here SR3. And we have seen the week candle closed below the daily ascending trend line close, and that could technically might continue to see that as the market opens, the yield could be dropping continuously. That is very much possible. From what I'm seeing here from the chart, the daily chart closed below the ascending trend line. Yes, it closed below it. So we have to wait for Monday, Tuesday for forward guidance. So Monday, Tuesday will tell you exactly what the market wants to do. But I know for sure that there is a demand floor here. There is a very strong demand floor. SR1, SR2, ROS1, SR1, SR2, SR3, SR4, If price comes back here, it might make a W structure at 4.21 and start to reverse. So this is very much possible. So sometimes we can be patient to allow the market, let the market clear its zone. So if it clears this structure, this ascending trend line, very strong critical structure from February 2024. Look at it, SR1, SR2, break of structure, ROS1, SR1, SR2, break of structure, SR3, SR4. If price returns here, it will create a W structure and go back. If it's not doing that, then of course you see from up, we have a strong upper bound, ROS1, ROS2, and when price return here in the month of July, we have seen a sell-off from that structure, and that is why you see we are falling. We're on that bearish leg. That's a supply roof. That's a strong supply roof. And if you look at here, what happened here on Friday, you will see we have here ROS1, ROS2, and when price return, ROS3, and price has dropped to ROS level, creating a horizontal resistance structure at 4.4170. The US Treasury yield has stopped at that level after creating a strong structure looking like head and shoulder. This looks like the left shoulder, this looks like the right shoulder, and this looks like the main head. After break of structure, you can see that retest, and most likely the yield might continue to drop from what the structure is looking like. If you look at it from the line chart, you see the break of the neckline followed by a retest on Friday. This is on a daily time frame. You have here, this is a right shoulder, this is a head, and this is a red shoulder, the right shoulder, and you have a breakout from the neckline followed by a retest, and we could continue to see that the US 10-year Treasury yield might continue to drop. Where I'm anticipating a very clear turnaround will be at 3.98. 3.98 is my demand floor. So I'm going to watch Monday, Tuesday for forward guidance. And bear in mind that whatever the 10-year Treasury yield does, it affects the price action of gold. It affects the price action of DXY. It technically affects the price action of dollar itself. So you must use this as a guardian, so you need to know the clear direction where the 10-year Treasury yield is going. Where the yield is going is where the money is going. You cannot be greater than the yield. No matter who you are, you cannot. If you know how much other countries owe in US bond, you are going to be scared. It runs in trillions of dollars. China hold billions of dollars. Japan hold billions of dollars in US bond. So you can't be greater than this thing. It's way more than anybody. So when you are trading, pay critical attention to 10-year Treasury bond yield. Very, very important. It's key and critical. So at this level, I see a strong, we have here strong resistance, break of structure. We have here as a demand floor 1, demand floor 2, putting here on a choke hold and a possible demand floor. So you see price has formed the head and shoulder pattern here. This head and shoulder pattern, we have here a left shoulder, the head, and the right shoulder, and a breakout of the neckline followed by a retest on Friday. This could technically be a bearish continuation, a very strong bearish drop after we got a disappointing non-farm employment change data at 73, way below 106 forecast. So if we come at this level and we do not defend it and form a double structure and return back, then you could see that the US Treasury 10-year bond yield could continue to drop. And a break away from this structure will ultimately, whatever break structure away from this black ascending trend line will certainly come to this level at 3.974, where I hope to buy in again into the structure. And in a more aggressive sell-off, price might come here and still get disappointed and will come down to around the 3.4 level that aligns with the descending trend line. If you look at the descending trend line, ROS1, ROS2, ROS3, the breakout of ROS level followed by a retest 1, which is SR1, SR2, and price comes here will give you SR3. This is very much possible. While trading, you must know that everything is probability, and any key level can fail you. Any key level can fail you. Lower your expectation, lower your risk. Every strategy is struggling. No strategy supersedes the other. Believe it or not, no matter who is coming from. Bye bye.